In the Berkshire Hathaway annual letter to shareholders, Warren Buffett recently wrote about his opinions on stock buybacks. But what you guys may not be aware of is that Charlie Munger has also opined on share buybacks recently. And so in this video, that's what we're going to go over. So as you guys smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Now, at the Daily Journal annual general meeting, Charlie Munger was asked about his thoughts on share buybacks, and he actually opined, and I thought it was a pretty interesting answer. So let's dive right into that.
All right, the next question comes from David Cass, who's a professor of finance at the University of Maryland. He says he's a shareholder of the Daily Journal Corporation and would appreciate it if you'd answer one of these questions. The question that I'll ask from is President Biden has proposed increasing the tax on stock buybacks from its current level of 1% to a new higher level of 4%. What are your views on taxing stock buybacks?
Well, I'm strongly opposed because I think if you're a good culture has a lot of people that are good fiduciaries, and it is like stealing to do something dumb with the corporate money when you can get more advantage for your shareholders by buying back your own stock. And I like encouraging morality and decency and honor and so forth in your dealings with the people you're the fiduciary for. And so I agree with our president on some things, but this is not one of them. But yes, I disagree strongly. I think it's a big mistake to adopt that policy. But, you know, I'm a Republican. I sometimes vote for Democrats, but I am a Republican.
Now, if I heard that comment by Charlie Munger like 10 years ago, it would have went right over my head. He actually talked about a very fascinating and interesting concept as it relates to capital redeployment with companies and a challenge that they face every day. And so effectively, I'm going to use an example to try to explain exactly what he was trying to say. So you guys are well aware that I really like H&R Block. I really like the company under a certain share price, but let's take a look at how they redeploy capital as an example. So you can see that H&R Block is effectively generating 100% of their net income as free cash flow. So that's really good. And part of the way that they're redeploying their capital is that they're buying stocks. They are paying dividends as well, but they're also buying stocks. So here's the problem. What the government wants with the taxation of stock buybacks is essentially to stop them. They want companies to pay dividends. Okay, that's fine. However, what I'm going to show you next will demonstrate why the government shouldn't be getting involved in this space. So this is the H&R Block P&L, forecasted P&L as per the model that I hold for myself. You guys can get access to it at that lower tier of the Patreon. And so, you know, I'm forecasting around, you know, you can look at this company and just say, look, they're going to on average make around $4 per share over the next 5 years, a little bit less in the early years, a little bit more in the later years. And so based on the current share price, you know, you can already tell that it's trading for something under $38 per share because the PE yield is 10.5%. So 3.88 divided by something gives you 10.5. So that's kind of how you should be looking at this. Now, at the current PE yield, and I wrote it up here, there's a wide variety of capital redeployment opportunities that are competitive. Like they could invest their capital in opening up new locations, they can buy up new companies, etc. in the tax field, and they could probably generate a greater than 10% or 10.5% return on that money. And really what I'm trying to get across there is that every time you buy back your own shares, think of it from the perspective of like the company is also buying shares of a company, right? Company A. And what are they getting for that? Well, they're getting $3.88 per share for that. Now, that's not really how it works. The number of shares just gets eliminated, and so, you know, the net income, that's this 656, just gets spread amongst fewer shareholders. But this is kind of how you have to think about that acquisition if you want to look at it like an acquisition. And so depending on the share price, the company can get a lot more or a lot less value in terms of PE yield for the price that it pays for the shares. So in other words, if the shares are trading at $3.88, well, you know that the company is expected to earn $3.88 per year, and so the P, and growing, by the way, and so the PE yield that the company would generate on that purchase of shares would be 100%. So that changes your capital redeployment opportunities, because in that situation, which is what I'm trying to say here, what happens when the share price declines? Well, in that extreme situation, there are very few capital redeployment opportunities that will generate a 100% and growing equity yield that you would generate on that. And so this is something that somebody else recently commented in one of the videos in the comment section, essentially saying that, you know, buybacks are really a math formula or a math problem. There are certain situations where it makes a lot of sense to redeploy excess capital into share buybacks. Now, you also have to consider, you know, competitive positions and maintaining that, et cetera, et cetera, et cetera. There's a whole slew of decisions that have to be made before you repurchase shares, even when your company's trading at 1x earnings and your earnings are sustainable. But the point is, why would the government want to get involved in this decision? It just doesn't make sense to me. And I think that's what Charlie is saying, because, you know, allow the management to deploy capital, allow the government to operate government. But when the government sort of like gets into this space, it becomes a little bit challenging. And I think that's kind of what he's trying to get across with that point. But I think it was a very fascinating point. But the thing about Charlie Munger and Warren Buffett is sometimes they speak in like riddles. You almost have to know the complexity to understand exactly what they're saying, because they'll talk about it at such a high level. And so I wanted to explain my interpretation of that comment, but I want to know what you guys think. So let me know in the comments below. Now, if you were to ask me, and I know you guys aren't asking me, but my opinion is more from like a tax guy perspective, because, you know, I have worked in tax. I own a tax company as well. And so the way I think about it is, you know, corporate income is already taxed, and then dividends are already taxed, and capital gains are already taxed as well, albeit the tax is just delayed. So what the government is really doing here is that they're speeding up the taxation for capital gains. And so my opinion is, look, if you want the taxation right away, like if you want that money right away, give people the credit for when they get capital gains later on. So in other words, you know, if you're going to tax corporations for buying back shares, find a way to flow those tax credits to the shareholders who are generating capital gains with the company. Now, that's very difficult to do. I don't really know how you would do it, but that would sort of like preserve fairness. I think the best solution here is just to stay out of it. And so I don't know, you guys let me know what you think. And so I'll leave it there. Comment below and let me know what sort of like solutions that you guys have here. Ultimately, my solution once again is don't tax anything. Now, I recently put out a video of Charlie Munger talking about a potential for conflict with Taiwan, and if you missed that video, you can get to it right here.